Module Overview. By the end of this module, you will be able to understand the purpose and components of the statement of changes in equity, identify how various transactions affect owners' equity, analyze retained earnings, share capital, and reserves, track changes in equity due to net income, dividends, and share issues, interpret the implications of equity movements on company valuation. What is the statement of changes in equity? The statement of changes in equity, SOCE, also called the statement of retained earnings or statement of owner's equity, shows how equity has changed over an accounting period due to a period of time, profits or losses, dividend distributions, share issuances or repurchases, adjustments for accounting errors or revaluations. It reflects how the owner's value in the business has increased, decreased, or shifted based on operational and financing activities. Components of equity. Equity consists of several key components, including A. Share capital. Represents the value of shares issued by the company. It may include common stock, preferred stock, par value, and additional paid-in capital. B. Retained earnings. Accumulated profits kept in the business after dividend payments, affected by net income loss. Dividends declared prior period adjustments. C. Reserves. Revaluation reserve arises from revalued assets, e.g., real estate. Capital reserve generated from non-operating activities. Foreign currency translation reserve for multinational businesses. D. Treasury shares. Shares repurchased by the company and held in its own treasury, reducing total equity. Key transactions that affect equity. In this course, we will be using transaction and effect on equity in our table. 1. Net profit increases retained earnings. 2. Net loss decreases retained earnings. 3. Dividend payment decreases retained earnings. 4. New share issue increases share capital. 5. Share buyback decreases equity via treasury shares. 5. Asset revaluation increases revaluation reserve. 6. Correction of prior period error, adjustment in opening balance. Why the statement of changes in equity matters. Shows owner profitability, helps determine how much profit is reinvested or paid out. Highlights internal financing, reveals how much growth is funded from retained earnings. Improves transparency, breaks down exactly how equity changes over time. Supports investment decisions. Investors use it to assess dividend policy and profit retention. International Financial Reporting Standards, IFRS perspective. According to IAS 1, Presentation of Financial Statements, the statement of changes in equity must present total comprehensive income, including gains losses not in the income statement. Disclose transactions with owners, e.g., dividends, share buybacks. Separate changes in each equity component, e.g., capital, reserves. Example, equity movement in a real-world business. Let's say Edotech Ventures Limited had the following transactions in 2024. Opening equity, 10 million naira net income, 2,500,000 naira dividend paid, 700,000 naira revaluation, gain, 400,000 naira share. Issue, 1 million naira. Then, closing equity, 10 million naira plus 2,500,000 naira minus 700,000 naira plus 400,000 naira plus 1 million naira equals 13 million. 200,000 naira. Text. Closing equity, 10 million naira plus 2 million. 500,000 naira minus 700,000 naira plus 400,000 naira plus 1 million naira. 13 million. 200,000 naira. Common mistakes to avoid. Confusing net income with retained earnings. Retained earnings equals accumulated profits, not just current year. Forgetting to record dividends in the equity statement. Ignoring revaluation reserves or accounting adjustments. Failing to reconcile opening and closing balances of equity components. Summary of key takeaways. The statement of changes in equity shows how equity evolves during a financial period. It includes profits, dividends, share capital changes, and revaluations. Equity reflects ownership value and its composition matters to investors. Understanding changes in equity supports smarter investment and management decisions.